So we have a married couple and they're 52 years old and they're making $300,000 a year. Now they're W-2 income, which means that they're not business owners. They work for a company and they're receiving a paycheck, maybe a salary. And one of the challenges are one of the challenges is when you work for a corporation, you don't have as many options for deductions as you would maybe if you're a business owner. And so become limited and then you feel like you're just bleeding taxes. So here's a common scenario. So you make $300,000 a year and you get a standard deduction of $30,000. Federal and state taxes might be about $69,000 if you did nothing to reduce that. Okay, so that's kind of our base case scenario, right? Now, most employers are going to offer something like a 401k plan. If this employee is over 50 years old, they can use the catch-up provision. And so you're looking at, $30,500 that they could put into a traditional 401k account. That'd be deductible. So that's great. Then in addition, and this is becoming more well-known, but I want to make sure that we talk about the HSA. A lot of times through your benefits through your employer, you're going to have the ability to choose a higher deductible healthcare plan and making you eligible for using an HSA. We love to see people do that. That could be another $8,300 that you could put into that if you're using the family plan. Then there's always charitable contributions, right? You could donate to your church, or you could even invest in a donor advised fund. Let's just, in our case, say here that was $15,000 going into that. Then if you factor in after these, we'll call them low-hanging fruit, kind of taking the available accounts to you under most employer plans in most situations, you're now looking at about $58,000 of taxes owed. So